Hello everyone, thanks for your interest in our content. This video will recap the highlights from our webinar discussing how the new Florida law affects an estate planning technique we've talked about often, called a Spousal Lifetime Access Trust, or SLAT for short.
Just want to start off the seminar with the global picture that we usually start our seminars out with regarding these type of topics. And we're in a situation where we almost have the perfect storm for estate planning. And for a lot of people that haven't planned yet, you're lucky that you still have the opportunity to do some of this very significant and very exciting planning that we're going to be talking about today, especially some of the updates that we have for the Florida law, which is going to be effective July 1st of this year. But when we're going through the perfect storm, we have the all-time high, federal and state deficits. The government's, meaning the governmental bodies and authorities, are going to need money to keep operations going forward in the future. So we don't think that taxation's going to be going down anytime soon. We have all-time high $12,060,000 exemption for federal state tax purposes, which gives us a lot of room to maneuver in this great environment. We also still have a lot of wonderful attributes that are still available for planning, such as valuation discount planning. And we have historically low tax rates, especially for income taxes. The people who listened and the people who executed were very, very happy that they've implemented the planning discussed today, because the interest rates are slowly but surely rising, from 2019 to the current stage. But we expect rapidly rising interest rates going into 2022 and 2023. And a lot of this planning can be enhanced by low interest rates. So the sooner you get going on the planning, the better. Also, last but not least, we're still in an environment we have a lot of the traditional tax benefits, such as capital gains step up and the like.
A spousal lifetime access trust is a trust set up by one spouse for the benefit of the other. And generally speaking, it's an irrevocable trust. So if I create an irrevocable trust, generally I cannot be the trustee, control person / manager of the trust, and I cannot be the beneficiary. So however, if I create a trust like that, my spouse can be that trustee, manager person, primary beneficiary, with kids, grandkids, and other combination thereof. And if I create this trust, I can take an asset and gift or sell it into this trust for the benefit of my family. And one of the reasons why this has become such a hot planning item is that, last fall, Congress introduced some bills where they tried to greatly lower, one, the current $12.06 million estate tax exemption, and two, they actually tried to take away certain planning vehicles and strategies, specifically grantor trust, such as the Spousal Lifetime Access Trust. The federal government doesn't care when you give away your wealth. If you give it away while you're alive, it's considered a gift. If you give it away when you pass away, it's part of your estate. But either way, you're locked in to whatever that estate threshold amount is, which is currently that 12.06 million. If I knew that tomorrow that $12 million threshold was going to drop to 1 million, I might be motivated to lock in that threshold at 12 million while it exists today. And I also, if I put anything in there, it'd be great if it was asset protected, if myself or one of my family members were to get sued. And on top of it, if I put some value in that today and it appreciates over time, I want all that appreciation to happen in a way that doesn't count against me from an estate or death tax perspective. Let's say I create a SLAT, an irrevocable trust, of which my wife and my kids are the beneficiary of, and my wife's the trustee. If I put $1 million of value into that trust today, that burns 1 million of my current $12.06 million estate and gift tax exemption. If I put $1 million in that today and then I die next week, when I die next week, I don't have a $12.06 million threshold. I have an $11.06 million threshold because I already used up $1 million while I was alive. However, if that $1 million grows to 2 million, maybe in a week, that's an aggressive example. But that growth on that number doesn't count against me for those calculations. It's all outside of the estate. And it's also common for married couples, and it doesn't just have to be married couples that implement similar types of plans and trusts as this. But if I create a trust for my wife, she can create a similar trust for me. So between each other, we can gift to one another, and between the two of us have full control and access of the dollars. But for tax purposes, move that value outside of the estate and all the future appreciation. How do we create the most bang for our buck and get the most efficiency out of creating a structure and a plan like this? And this is an example of this, where we have Joe and Mary Smith. They have $5 million of, let's say, marketable securities that they'd like to do some estate planning with. In this example, we create an LLC, Smith Investments LLC, and Joe and Mary fund that LLC with their $5 million worth of marketable securities, a brokerage account. So on day one, they just create a brokerage account inside the LLC, they fund it, and Joe is the manager of the LLC, meaning Joe still works with his investment team. They've essentially created a new account. He's on that account. His investment philosophies and everything he's doing historically still rolls along. And Joe and Mary, in this example, own this LLC, whereby Joe has 98% and Mary has 2%. And instead of taking that $5 million of value and just gifting it into a SLAT, instead, Joe's going to take his 96 non-voting units here in this example, the non-controlling equity of the LLC, and so instead of gifting it away into the SLAT, he's selling it into the SLAT in exchange for a promissory note. So a couple of key concepts there. One is Joe still wants to be in charge of the $5 million of value, which he is, because him and Mary are the voting members and partners of the LLC. And Joe's the manager, meaning he dictates the day-to-day government of that account. He wants to move value out of the estate. So instead of moving the actual monies, he's moving 96% of the LLC ownership into the SLAT, which is the green box here in the flow chart, the Joe Smith 2022 Irrevocable Trust. But a key concept here, when he values those LLC units, when he gifts into the Irrevocable Trust, you would think it'd be worth $5 million because there's a $5 million of publicly traded securities inside the LLC. He's selling away essentially all of that LLC. But here we value that sale at $3.5 million. Reason being, given the historical rules and planning that's still available to us, it's come under attack the last 6 years, but we're still allowed to do what we call valuation discount. Because Joe isn't putting the actual marketable securities into the SLAT here, he's selling the LLC units into the SLAT. We can discount that value for lack of marketability and lack of control. We go out, get a separate valuation firm to do that. And generally speaking, not always, it's about a 30% discount. So when Joe sells these LLC units into this SLAT, Joe receives a $3.5 million promissory note back to him or his revocable trust. And the SLAT itself has $5 million of LLC units. So on day one, there's $1.5 million roughly of value inside this SLAT outside of the taxable estate, and Joe hasn't used much of any of his actual exemption. That 30% discount is $1.5 million outside of a 40% of future estate tax, plus all the future appreciation. Plus, Joe still has a note back to him for $3.5 million to hedge any risk of future gifting remorse or anything like that. And if you run some math, assuming a 7% return on the underlying assets, the note comes back to Joe, that is an annual interest payment that must be due. There's what's called the applicable federal rates, or AFRs, that get published on a monthly basis. Once you utilize that in a month, the interest rate is locked in, but every month they get republished. And to Andy's point earlier, we only anticipate those interest rates, at least for a while here, to keep steadily increasing. And this SLAT has a bunch of equity in it. The appreciation is happening there. And Joe still has the promissory note back. And again, running the numbers at 7% rate of return after the 9 years here, which is the length of the note we used, there's roughly about $4.4 million of value in that SLAT. And at a 50% Illinois and federal combined rate, it's savings of over $2 million. Or a state like Florida, without a state level estate tax, but just with the federal government, it's just under $2 million, of overall tax savings. And that's just after 9 years. You can do the math for yourselves. And if you put $5 million of underlying value in a transaction like this, what do we think that's worth over 9, 15, 20, 25, 30 years? That compounding value of those accounts can really move a lot of value outside of taxable estates.
Florida, over the past couple of years, has made some changes to the Uniform Trust Code. The main reason a lot of this is being done is Florida is trying to be more and more competitive from a trust standpoint, so that people are setting up trusts here. The other point Bob was alluding to is that generally, in most states, you can't set up a trust, put your assets in the trust, and be a beneficiary of the trust and basically tell your creditors, too bad, you're not going to get me. It doesn't work that way. So in Florida, historically, is a jurisdiction where you can't do that. So Florida, trying to be competitive, has made a recent change. This is new legislation, obviously. And so the one piece, again, is the creditor piece. And since the state of Florida is basically saying you'll get creditor protection, that's excellent. The other piece is what happens from an estate tax planning standpoint, right? We went ahead, we set up the SLAT, we did all the analysis, we did all the work, the drafting, moved the assets, did all that work. What is the IRS going to say? But there is some guidance out there that can give people comfort that, this should work from a tax perspective. Again, this is a very important change in Florida law. Makes SLATs much more appealing. From a drafting perspective, we would definitely want to be very conscious of what we draft, what we say, and what we put into the trust to make sure we put all the bells and whistles on it so that it does withstand IRS scrutiny. This new rule would apply to a SLAT that is created or funded after July 1st of 2022.
For the clients in both Illinois and Florida that did SLAT planning in the past, congratulations, because economically, because of the interest rates rising, most of those clients are going to be in a better position than even clients currently planning or going into the future, because the interest rate environment was lower. So for the people now that are looking to get into SLAT planning or really interested in this, just know that for Illinois purposes, the risks that we talked about with the a spouse passing away and having access to the trust, we have methods to alleviate that risk very significantly. So it really isn't that big of a risk. And also for purposes of the Florida items that were discussed by Darren, those apply mainly to Florida residents. Okay, so in order to get the benefit of the new Florida SLAT statutes allowing the second spouse to die to be a beneficiary and have access to those SLAT monies, that's a new thing. And that's something that's available to Florida residents only, not to Illinois at this time, unless you move, right? Which a lot of our clients are doing. And if there are some folks who have established Florida SLATs in the past with our firm or with other firms, we will find the way and the method to make sure that we can get your SLATs amended so you can get the benefit of the new Florida statute. Although there is a little bit of wait to, we have to wait to see how the law evolves a bit. But my guess, based on my many years of practicing law, is that we're going to be able to get you to the optimal place relatively quickly. The current law is that as of December 31st of 2025, the law currently is, right, that the federal exemption is going to be reduced to $5 million adjusted for inflation. So that is something that's already in the law that will sunset. That's not something that we're guessing about. That is the law. So that risk of losing that exemption is very real because it's already written into the law.
This has become such a big planning topic that if you were to pick this up, in the later half of the last 2 years, October, November, December, you'd have been hard pressed to get a planning group that had the capacity to even get it done. So whether this is something you've looked at before or you're just looking at for the first time to get it done, the sooner the better to get moving on it.
If people wait too long, to do the planning, then they can miss out. So the sooner, to Bob's point, this is something you want to get on and get on quick.
For more information about the topic discussed in this video, please feel free to contact any of our speakers directly. Thanks for listening.